Welcome back to Let's Talk Tax, powered by McGuire Sponsor. I'm your host, Dave McGuire. In today's episode, we're covering two major developments every CPA firm and small business should have on their radar. Joining me today are two of our firm's R&D experts, David Seibel and Garrett Duffy. Together, we'll break down what this guidance really means, how Section G is changing the game for compliance, and what CPA firms need to do now to help their clients stay ahead. Well, welcome, David and Garrett. I'm not used to doing these with two people, so instead of me introducing both of you, David, why don't we start with you? Why don't you tell me a little bit about yourself, how long you've been doing R&D work, and what's your role within McGuire Sponsor?
Yeah, I'm currently a shareholder for the R&D practice at McGuire Sponsor. I've been doing R&D tax credits for almost 15 years now. It'll be 15 years in November. So I am also one of, as you pointed out, one of the R&D technical experts. So I'm one of the ones that gets to digest all of these new guidance and suggest paths forward on how to actually comply with them.
And Garrett, how about yourself?
So I started back in 2018 with McGuire Sponsor in the R&D tax credit practice. And over the last couple of years, I've transitioned into a relationship manager role where I'm helping to build out our CPA relationships in the Northeast. But I'm still intimately involved in our research as it relates to the R&D tax credit and how we can apply some of these things towards our clients.
So it sounds to me like you're two of the better people to ask as it refers to some of these technical issues around the R&D tax credit. So let's take a step back. So I mentioned in the opening that we have this new revenue procedure dealing with 174A, and I know whenever I'm sitting in front of a tax group or a CPA firm, somebody inevitably raises their hand and just goes, hey, stop talking in numbers and letters, because we do that a lot. So what is 174? What's this new 174A provision? Why are we here? So I don't know.
Yeah.
David, you want to give me a little bit of background there?
Yeah, so Section 174 is the tax code related to research and experimental expenditures. So the Tax Cuts and Jobs Act made it so that taxpayers beginning after December 31st, 2021 had to start amortizing their 174 costs over 5 years domestic or 15 years international. And that was a change in policy where prior to that time, taxpayers had the option to deduct those costs immediately. So it was really a large burden for taxpayers to comply with 174 amortization for those years. And then the most recent tax bill, the One Big Beautiful Bill, made it so that they created a separate tax code provision, which was that 174A, that starts for tax years beginning after December 31, 2025, or 2024, sorry. And what that does is it restores that ability to deduct the domestic costs immediately, or you could also amortize them over a period of not less than 60 months if that's an avenue that a taxpayer would want to pursue. So it restores that domestic deductibility for those costs. Foreign expenses still have to be amortized over 15 years, and that's going to be where 174 is now housed. But as a part of the One Big Beautiful Bill too, there were a couple other different provisions that allowed some relief for those taxpayers that complied with 174. One option that's available to any taxpayer is that they are able to accelerate their remaining deductions for the 22 through 24 period that they still have to amortize, accelerate those on either the 25 return and take the remaining deductions all in 25, or they can spread out over 2 years over the 25 and 26 returns. So again, that option is available for all taxpayers. And then eligible small businesses, which is defined as taxpayers that have under $31 million or less in gross receipts over the 22 through 24 years, they actually have the option to change the effective date of 174A expensing from tax years beginning after December 31st, 2024 to tax years beginning after December 31st, 2021. So that essentially allows them to go back and amend and deduct those expenses in the year incurred, which could result in some pretty significant tax savings for those that had to pay those increased tax bills for the 22, 23, and 24 years.
You were talking about 174. We mentioned that you're both R&D experts.
Mm-hmm.
So when we talk about 174 expenses that have to be amortized after the TCJA, Is that the same as the R&D tax credit where people are getting this tax credit, or are they two different provisions? How do they intertwine?
Yeah, there are two different provisions because the research credit is under Section 41. All of those costs are considered 174 costs, but not all 174 costs are eligible for the R&D credit. So it's a broader range of expenses that would have had to be amortized during these years than would be eligible for the research credit.
Okay. So it sounds like this change into the One Big Beautiful Bill was welcome by a lot of taxpayers. But I have noticed that there's not been a lot of guidance on a lot of these areas. So, Garrett, it looks like this new RevProc 2025-28 came out quicker than some other areas. So what was the uncertainty that we had to get this so quickly, and what was some of the things that it explained to us?
So a big thing that taxpayers were wondering is, hypothetically, I still have my 24 tax return open. Do I have the ability to expense those costs now, or do I have to wait till 2025 to make the decision, or did I have to do it on an amended return? So with this new procedure coming out, it allows some of these small taxpayers to make those elections now, so fully expense R&D cost in 2024 with the provision that they also have to go back and amend 22 and 23. So they have to be consistent in whether they're going to carry forward or go back and amend. It also provided guidance on like what statements need to be attached to those tax returns so they're fully in compliance. It also provided additional procedures for maybe they're a BBA partnership and they have to go through an AAR procedure, or is it just strictly amended tax returns? Does it need to be also attached to shareholder returns, et cetera? So there was a lot of relief in, okay, yes, we can do this, but all those nuanced questions that we've had, the guidance provided pretty much comprehensively what we need to do going forward. So one, it's not an administrative burden for 2024, filing a return and then amending immediately, but also it still provides opportunities to go back and amend. So that's, given the short window, it provides options for small taxpayers.
So considering 9/15 has already gone by, does this new guidance, does it affect many people, or are there other people that will get affected by this that are maybe not the traditional 9/15 filers that were on extension?
So you might have smaller C corps that file for 10/15 that still have an ample window to do this. You also have your fiscal year end clients. So they might be a 3/31 fiscal year end on extension that's due 12/15 or something. So it gives us an ample window, especially for clients that have more extended time to look at this, to make more educated decisions on how they want to utilize the One Big Beautiful Bill, whether it's just fully expensing in the prior years or carrying forward those deductions into 25 or 25 and 26.
Now, I want to step back on one thing you mentioned. You said earlier, okay, you could have the option of taking this on your 2024 extended return, but only if you go back and amend 22 and 23. So let's say I'm a taxpayer and I didn't realize that little caveat, and my CPA firm filed my 24 return and started not paying attention to the 174 amortization, but I didn't 22 and 23. Are you saying now my only option, because we're past that 9/15 date, is that I'm now going to have to go back and amend 22 and 23 most likely?
Most likely, yes. There is a carve out for if you didn't have research in those prior years where you just have to amend the affected years. But in most cases, unless it's a startup company that started in those years, we're going to see that they're going to have to amend those past years as well.
Now, a little bit of clarification here. Let's say, and I know, David, you mentioned earlier that 174, the R&D amortization requirement, and Section 41, the R&D tax credit, are decoupled. They're not the same thing.
Mm-hmm.
But let's say I was under the false implication that if I ignored my R&D tax credit, I didn't have to worry about 174. Can I go back and amend prior returns for the R&D tax credit? And does that require then that I take the 174 on those returns, or can I go back and amend for 41 and still make the decision to pull 174 forward?
Yeah, I mean, going back and amending to claim the R&D credit is still on the table, whether you're a large or a small business. Particularly if 24 is already filed, there is an avenue to go back and amend, if you're a large taxpayer, to go back and amend the 22, 23, 24 returns, claim the R&D credits, still recognize that there are 174 costs incurred in that year, and then be able to then take that 481A adjustment and then also offset it with that accelerated deduction for the 25 return to make a net neutral 481A adjustment. So definitely opens the door for taxpayers to be able to go back and disclose that there were 174 costs and be able to recognize the benefit of the R&D credit. Similar to small taxpayers as well are able to do that and just not have to file that 3115. Still file those disclosure statements that Garrett referenced, but to be able to deduct those just immediately on the ones under 174A for those years.
So, Garrett, you said you're one of the relationship managers. You meet with a lot of CPA firms. Let's say I've already filed my 2024 return and I had to deal with 174 amortization. I dealt with 174 in 22, 23, and 24. What are some of the considerations that a CPA firm should look at when they're making that decision? Do I pull this forward on a 3115 or do I go back and amend to fix 174?
So there's a couple things you want to consider. So if there's a decision to go back and amend, there's a 280C election you got to take into consideration. So by amending those returns, the previous provisions for the 280C come into play. So credit has to be fully added back. So if you make the 280C election, it reduces your credit by 21%, the corporate tax rate. So you're going to get reduced credits in those years. Also, you got to consider how long is it going to take the IRS to actually process these returns. As if you're familiar with ERC and some of these other credits that people have pursued, some of your refund claims have birthdays at this point. So it could be an extended period of time. But look at a taxpayer, you have 25 almost done. You can make some cash flow decisions now to maybe not purchase a piece of equipment or purchase supplies in advance, so you have larger taxable income that you can utilize some of those deductions to offset that are going to be carried forward. So clients, if they're planning now, are in a unique position where they can make some financial decisions for the next couple months where they can fully utilize the deductions that are being carried forward. So there's options on the table. That's the great thing.
Yeah, I would say the biggest factor is there going to be that tax liability in 25 to be able to utilize those accelerated deductions in that year? Because as Garrett pointed out, we know that timing is going to be a big issue when it comes to those amended returns. So if you're able to utilize those deductions in 25, it may result in a quicker refund than having to wait 12, 18 months for the IRS to process those refunds if you're a small business taxpayer.
And this is just for my edification. So I'm coming from the depreciation side of things, where we always think depreciation doesn't go away. And if I don't do a cost seg study this year, I can file a 3115 next year, or I could even wait 2 or 3 years and file that 3115. With the 174 change, is that still something, let's say I don't have the taxable income in 2025, or maybe I didn't even on the amended return issues. Is that something I can sit on and go, you know what, I'm going to deal with this in 26 or 27 or 28, or is it something I really need to start thinking about as I'm doing my 2025 planning?
It would be something that has to be done on the 25 planning, because those accelerated provisions can only be applied on the first tax year beginning after December 31st, 2024. So it's limited to the 25 and or 26 tax years. So that planning has to occur. Otherwise, there's still the option to let those 22 through 24 schedules, amortization schedules, run through their course. That's always still an option. But if you're looking to do that acceleration, that has to start on that 25 return.
So if I don't deal with it, my tax planning opportunities dry up, and I'm just stuck with that amortization trail.
Correct.
Okay. Now, I know that covers some of 174. Now, I know that's not the only thing that we're dealing with on R&D.
Mm-hmm.
I know in the recent years we've seen some changes and some more complexity and some more information requested by the IRS. And I've been hearing something about some infamous Section G, but we talk about it once again. It goes back to the numbers and letters, and we don't actually explain. Why don't you give me a quick overview? What is Section G? Why is it important? And what do we have to deal with?
Yeah, so pre-2024, which again, we're going to say numbers and letters, Federal Form 6765, which is the research credit form, it was really a 2-page form, and it was just a very high-level overview of the total expenses and the calculation, total expenses incurred by the company for the year that were qualified for the research credit, as well as the calculation. Didn't have anything related to the qualification criteria, any information related to the business components or the projects that were being developed by the company for those years. Starting in 24, the IRS released an updated Form 6765 with additional sections. The biggest one of those was Section G, that had the taxpayer break down each of the qualification criteria, as well as the amount of expenses incurred for each of the projects or business components being developed. So again, before it was just a general total amounts of QREs incurred for each of for the company. Now it requires, Section G requires a breakdown of project by project, qualification, what type of project it was, as well as the expenses for those business components. So definitely a much bigger bar to disclose and document for taxpayers versus pre-2023 and before.
In terms of the work we're doing, when we're doing an R&D tax credit study, is most of that information already included in what we're doing, or is this a change to what we have to do? Or is it really just we have to now take some of the stuff that's in our report and put it on a form somewhere?
So it's going to be client specific because they have small taxpayer provisions where they don't have to fill out Section G. But for those larger taxpayers, this is all information we discussed over the course of over field work and part of our report, et cetera. But now it needs to be put into a format, as well as collect some additional information that we might have been looking at a sample of projects. Now we might need to look at up to 50 projects as may be required for Section G. Mm-hmm. And for some of our taxpayers that may not have been as forthright at providing this information, it's going to be a requirement going forward. So it's definitely might be a bit more of a burden for some of them, but if they want to still pursue the R&D tax credit, it's necessary.
Does this change those? Let's say I'm a taxpayer and I hired somebody to do an R&D tax credit study for me 10 years ago, and I've just been leveraging off of some of the numbers. Would this change my ability to do that? I'm not saying that was correct. I'm going to caveat that. That's probably, I wasn't doing the right thing, but is this new Section G going to limit my ability to just go, these were the numbers I used last year, let me update them for this year?
I would say definitely, especially for those larger taxpayers. It's where they've probably historically just thrown blanket percentages at just employee pools. They're really going to have to dive into and explain, okay, how are those employee costs divvied up between projects? And maybe they've never really looked at that. They've just kind of taken blanket percentages. So it's definitely an opportunity where they need to take a step back, reevaluate their process, and probably bring in someone like McGuire Sponsel to assist.
So with all that said, we seem to be in this interesting planning year with the 24 coming to a close and we're getting into 25. What are some of the key things that CPA firms should be talking to their clients about to make sure they're planning for that 2025 return in this, as we said, kind of a critical year?
Yeah, I think as it relates to 174, it would be trying to model out what would be the best approach, whether it's accelerating using the accelerated deductions for the 25 and maybe 26 returns, seeing whether it makes sense to go back and amend if you're a small business taxpayer for 22, 23, and 24, or if it just makes sense to go ahead and just let the amortization schedules play out. That's probably the biggest consideration from a 174 perspective.
Garrett, do you have anything that you would like to add?
There's also the timing consideration, because if you want to go back and amend, July 6th is that date of 2026 that you have to get it all done. But for a 22 tax return, you might have an earlier statute date. So you might have filed on time. That might be March 15th or April 15th. So that truncates that timeline. So it's important to start looking at this now so you have ample time to make any sort of corrections you plan to.
So I just want to confirm. So what you're saying is not only do I have to worry about the statute date, but if I'm going to amend, I also have to have the amended returns for those other issues in by July 6, 2026.
Correct.
Okay. I just wanted to clarify that because going into this, I wasn't that aware of that date, and I wanted to make sure that we reinforce that. Well, I appreciate both of your insights and some of the things you had to add today. I just want to reinforce, it seems like this is going to be a big tax planning year. Whether we're a large company and we don't get to worry about that amended return and we're flowing it through, or if we're a small company and we have to look at, do we go back and amend? Do we pull it forward? How do we handle this? It sounds like as it relates to the R&D tax credit, this is going to be a big year no matter what. And then you couple that with the increased scrutiny on Section G, I think it's going to be an interesting year for everybody involved in the R&D tax credit. And I would reinforce, if you're a CPA, kind of trying to navigate this stuff, as we kind of mentioned today, we've got experts here. I mean, I think both of you kind of reinforce that you have knowledge in this, that you understand the tax code sections. You can talk in the numbers and letters really well. So I appreciate both of your times today. Thank you for joining us.
Thank you.
Thank you.
Thank you for taking the time to tune in today. You can subscribe to the Let's Talk Tax podcast on YouTube and follow us on Spotify, Apple Podcasts, or wherever you listen. In addition, today's show notes and links to more about this episode can be found online at mcguiresponsel.com/Let's Talk Tax Podcast. We'll see you next week. Thanks, everybody.